Valued at 25 trillion US dollars, trade is a pillar driving the global economy, moving goods and services, driving prosperity and creating opportunity. Today, it is virtually impossible to talk about the future of trade without reference to blockchain and distributed ledger technology. In our 2021 report, DMCC found that global trade defied expectations despite the economic challenges posed by the pandemic. But we wanted to take a closer look at how technology remains the most transformative element of global trade. And specifically, if and how blockchain and decentralized finance, known as DeFi, is accelerating growth. For instance, is DeFi an alternative to traditional financial infrastructures? What are the opportunities and risks for both the developing and developed world? How can regulation develop without obstructing innovation? As the world's flagship free zone and global hub for commodity trade, Dubai's DMCC set out to find the answers. First of all, what is DeFi? DeFi refers to blockchain-based platforms and products that provide financial services, such as trading, securing insurance, and sending, lending, and borrowing money. Built on top of smart blockchains, these platforms enable governance and execution of a variety of transaction types without the need for centralized infrastructure. The result? Transactions at far lower fees than both traditional financial institutions as well as other fintech applications. And while DeFi is not reinventing the underlying economic needs of a marketplace, it does promise a capital market that changes how financial products are manufactured and accessed. And that will impact global trade. Today, financial services center around those that wish to interact with each other, not around one single institution or one single national market. If we expand the definition of financial instruments to include crypto or digital assets, everyone can have access to financial services in the blockchain ecosystem through the internet and a smartphone. Individuals can be their own bank. This would help the 1.7 billion adults globally who do not have access to banking services. Public blockchains like Ethereum or Cardano make it possible to create markets and connect market participants around the world. That means a flood of potential new users and businesses, many in developing nations. DeFi opens up new capital opportunities for larger companies and increases liquidity for SMEs, helping bridge the gap in trade finance. And that is not a small gap, $1.5 trillion. So how is DeFi impacting the financial sector? By Q2 2021, large institutional transactions accounted for over 60% of DeFi. This key shift raises a flag for the traditional financial players that choose to remain on the sidelines. Why? They could lose not just retail and commercial business, but face fierce competition for large institutional clientele. Meanwhile, many banks recognize the need for change. 55 of the top 100 banks have already invested in cryptocurrency or blockchain-related companies. Transaction banking, which fuels day-to-day businesses and financial institutions, is big business. In 2020, industry-wide transaction banking revenue reached $1 trillion. DeFi negates the need for relationships with trusted intermediaries, which makes the model disruptive. Not just for banks. Using blockchain in trade finance means greater transparency between international parties, reduced costs in cross-border transactions, and a reduction in errors in documents, as well as greater speed. However, DeFi still lacks two crucial elements: a one-to-one exchange with fiat currency and interoperability between different blockchains. Interoperability is crucial for transactions to occur at scale in the highly fragmented blockchain space. DeFi still has a steep learning curve, even as opportunities in the space evolve and new protocols emerge. Complete and utter control over money, especially in digital form, may not be easy to handle. DeFi has the potential to replace large swathes of traditional finance, providing huge benefits across the supply chain and to trade and empower SMEs. These innovations will have obvious knock-on reform effects. Governments and banks will have no choice but to innovate. And while DeFi promises significant benefits, it also comes with potential risks. Networks are decentralized and do not require interaction with the regulated financial system nor other national legal regimes, such as taxation and national identity systems. Regulators must strike a balance between risk mitigation and innovation through responsible regulation. Meanwhile, it is important that the industry engages and educates the regulatory authorities who are grappling with a new reality. Jurisdictions that work together with the industry stand to gain the most, providing clarity, smart legislation, and regulation. The UAE and Switzerland are good examples, introducing policy to make it easier for companies to set up and operate while ensuring a number of protections are in place. So, what happens next? Whether DeFi will merge with the existing river of traditional finance or carve out its own canyon altogether remains to be seen. As DeFi evolves, it could become a driving force in support of individual financial freedom and personalization. Ultimately, its success is an endeavor that involves numerous cogs, and its future has monumental implications for personal and corporate finance, global trade, human interconnectivity, and beyond. To find out more, download the special edition report at futureoftrade.com.